Hello everyone, and welcome back to Money Finance Wealth. Today, we're demystifying a critical retirement savings tool, the 401k. Before we dive in, if you're new here, please hit that like button, subscribe to the channel, and ring the notification bell so you never miss out on our in-depth guides to mastering your finances. We're all about providing you with the knowledge you need to build a secure financial future. The 401k is a cornerstone of retirement planning for millions of Americans. Understanding how it works, from contribution limits to employer matching and tax benefits, is essential for maximizing its potential. This video will cover all the essential 401k basics, empowering you to make informed decisions about your retirement savings. We'll explain everything in plain English, avoiding complex jargon so you can feel confident in your 401k strategy. Let's start with the fundamental question. What exactly is a 401k? A 401k is a retirement savings plan offered by many employers to their employees. It allows you to save and invest a portion of your paycheck before taxes are taken out, helping you build a nest egg for retirement. It's called a 401k because it's named after a section of the U.S. Internal Revenue Code. It's one of the most common types of employer-sponsored retirement plans, alongside pensions and other defined contribution plans. The key features of a 401k are employee contributions. You, the employee, contribute a portion of your salary to the plan. Employer contributions, matching. Your employer may also contribute to your account, often matching a percentage of your contributions, which is like free money. Tax advantages. Contributions are typically made on a pre-tax basis, reducing your current taxable income. Investment options. You have a range of investment options to choose from within the plan, allowing you to customize your portfolio based on your risk tolerance and financial goals. Tax-deferred growth. Your investments grow tax-deferred, meaning you don't pay taxes on the earnings until you withdraw the money in retirement. Now let's talk about contribution limits. The IRS sets annual limits on how much you can contribute to a 401k each year. These limits are subject to change, so it's important to stay informed. For example, in Insert Current Year, the employee contribution limit for 401ks is Insert Current Year's employee limit. This means you can contribute up to this amount of your salary to your 401k on a pre-tax basis. There is also a catch-up contribution for those age 50 or older. In Insert Current Year, the catch-up contribution limit is Insert Current Year's catch-up limit. This allows older workers to contribute more to their 401k and make up for lost time. It's important to note that these limits are for employee contributions only. Employer matching contributions do not count towards these limits. There is also a total contribution limit, which includes both employee and employer contributions, but this limit is much higher and less likely to be reached by most individuals. For example, in Insert Current Year, the combined employee and employer contribution limit is Insert Current Year's combined limit. The best approach is generally to contribute at least enough to get the full employer match. More on that in the next section. If possible, try to max out your contributions, especially if you're behind on your retirement savings or expect to be in a higher tax bracket in retirement. One of the most valuable aspects of a 401k is the potential for employer matching contributions. Employer matching is when your employer contributes to your 401k account based on the amount you contribute. It's essentially free money, and you should always take advantage of it if possible. The most common type of employer match is a percentage of your contributions, up to a certain limit. For example, your employer might match 50% of your contributions, up to 6% of your salary. This means that if you contribute 6% of your salary, your employer will contribute an additional 3%, bringing your total contribution to 9%. Some employers offer a dollar-for-dollar match, meaning they match 100% of your contributions up to a certain limit. This is an even more generous match and should be taken full advantage of. It's crucial to understand your employer's matching policy. Find out the percentage they match, the maximum contribution they match, and any vesting requirements. Vesting is the process of earning full ownership of your employer's contributions. Some companies require you to work for a certain period of time before you are fully vested in their contributions. If you leave the company before you are fully vested, you may forfeit some or all of their contributions. Always aim to contribute at least enough to your 401k to receive the full employer match. This is one of the smartest financial moves you can make, as it's like getting an instant return on your investment. Leaving matching funds on the table is akin to turning down free money. 401ks offer significant tax advantages that can help you grow your retirement savings more quickly. There are two main types of 401ks, each with different tax benefits: traditional 401ks and Roth 401ks. With a traditional 401k, contributions are made on a pre-tax basis. This means, you don't pay income taxes on the money you contribute in the year you contribute it. This reduces your current taxable income, potentially lowering your tax bill. Your investments grow tax-deferred, meaning you don't pay taxes on the earnings until you withdraw the money in retirement. When you take withdrawals in retirement, those withdrawals are taxed as ordinary income. With a Roth 401k, contributions are made with after-tax dollars. This means you don't get a tax deduction for your contributions in the year you make them. However, the big advantage is that your earnings grow tax-free, and your withdrawals in retirement are also tax-free, as long as certain conditions are met. The choice between a traditional 401k and a Roth 401k depends on your individual circumstances and expectations about future tax rates. If you believe you will be in a higher tax bracket in retirement, a Roth 401k may be the better choice. If you need the immediate tax deduction now and expect to be in a lower tax bracket in retirement, a traditional 401k may be more suitable. It's important to note that even if you choose a Roth 401k, any employer matching contributions will be made on a pre-tax basis and will be taxed as ordinary income when you withdraw them in retirement. Within your 401k, you'll typically have a range of investment options to choose from. These options may include mutual funds. These are baskets of stocks, bonds, or other assets managed by a professional fund manager. They offer diversification and can be a good choice for those who don't want to actively manage their investments. Index funds. These are a type of mutual fund that tracks a specific market index, such as the S&P 500. They offer low-cost diversification and can be a good choice for those who want to match the performance of the overall market. Target date funds. These are designed to become more conservative over time as you approach your retirement date. They automatically adjust the asset allocation to reduce risk as you get closer to retirement. Bond funds. These invest in bonds, which are generally considered to be less risky than stocks. They can provide income and stability to your portfolio. Money market funds. These invest in short-term, low-risk debt securities. They are designed to preserve capital and provide a stable return. It's important to understand the different investment options available to you and choose investments that align with your risk tolerance, time horizon, and financial goals. Diversifying your portfolio across different asset classes can help reduce risk and improve your long-term returns. Consider seeking advice from a financial advisor to help you choose the right investments for your 401k. Generally, you can start taking withdrawals from your 401k at age 59 and a half. If you withdraw money before age 59 and a half, you may be subject to a 10% early withdrawal penalty, in addition to paying income taxes on the withdrawn amount. This penalty is designed to discourage people from using their retirement savings for non-retirement purposes. However, there are some exceptions to the early withdrawal penalty. These exceptions include withdrawals for qualified higher education expenses, the purchase of a first home, up to a certain limit, unreimbursed medical expenses exceeding a certain percentage of your adjusted gross income, and certain other specific circumstances. It's important to research these exceptions carefully to see if you qualify. Required minimum distributions, RMDs, are another important consideration with 401ks. RMDs are the minimum amounts you must withdraw from your 401k each year, starting at age 73. As of 2023, this age may change in the future. The amount of your RMD is based on your age and the balance of your 401k at the end of the previous year. The IRS provides a worksheet to help you calculate your RMD each year. Failing to take your RMDs can result in a hefty penalty, so it's crucial to understand and comply with these rules. Let's talk about some common mistakes people make with their 401ks, not contributing enough to get the full employer match. This is perhaps the biggest mistake. Leaving matching funds on the table is like turning down free money. Not understanding the investment options. Choosing investments without understanding their risk and potential return is a recipe for disaster. Taking early withdrawals. Early withdrawals can trigger penalties and reduce your retirement savings significantly. Not rebalancing your portfolio. As your investments grow, it's important to rebalance your portfolio periodically to ensure that it aligns with your risk tolerance and financial goals. Ignoring fees. Be aware of any fees associated with your 401k, such as account maintenance fees or investment management fees. These fees can eat into your returns over time. Not seeking professional advice. If you're unsure about how to manage your 401k, consider seeking professional advice from a financial advisor. Understanding the basics of your 401k is crucial for building a secure retirement. Speaking of guidance, we'd like to thank Fanul Wealth Management for sponsoring this video. If you're looking for personalized financial advice and wealth management solutions, their team can help you navigate the complexities of retirement planning and build a strategy tailored to your specific needs. You can reach them at 888-336-8586, email info@fenel.com, or visit their website at fenelwealthmanagement.com. In summary, the 401k is a powerful retirement savings tool that offers significant tax advantages and the potential for employer matching contributions. By understanding the basics and avoiding common mistakes, you can maximize the benefits of your 401k and build a comfortable retirement. Thanks for watching Money, Finance, Wealth. We hope this video has helped you better understand the key aspects of 401ks. Remember to consult with a financial advisor to determine the best course of action for your specific situation. And before you go, please give this video a like, share it with your friends, and subscribe to our channel for more informative content on all things money, finance, and wealth. Your support helps us continue to create valuable resources for your financial journey. Thanks again for watching, and we'll see you in the next video.